We're looking at a common equity waterfall model capable of handling up to 22 years of yearly cash flows and for which we have also made available quarterly and monthly versions. In this fictitious example, the general partner, or GP for short, co-invests 5% of the equity capital along with the limited partner who puts up the remaining 95%. And this waterfall was designed to perfectly handle investment scenarios in which the GP contributes either no equity capital or a certain percentage of the capital, but depending on the returns he generates, he gets a performance fee regardless. Coming back to our initial 5% equity contribution scenario, through hands-on management, the general partner is 4 years later able to return the capital, getting his corresponding 5% share in proportion to his 5% invested equity. This is a pari passu distribution. Then over a year later, he manages to hit for both partners the preferred return hurdle, or Pref for short, in which in this case is equal to an 8% internal rate of return. And you could calculate the Pref based on other profitability metrics such as cash on cash or equity multiple, but in this case we are doing so based on IRR. Here again at the Pref tier, a pari passu distribution also takes place, as he is receiving a 5% distribution share in proportion to his 5% co-investment. By hitting the Pref, the GP consequently triggers a famous GP performance fee mechanism known as the catch-up, in which he receives a disproportionate share of equity distributions relative to his co-investment until he reaches a pre-agreed percentage of all cumulative JV-level equity distributions. In this case, we are saying that after achieving the Pref, the GP will get 80% of the following equity distributions until he reaches a 20% of all JV-level cumulative distributions. Now we can play with this input, so we can say, for example, that we would like him to get 100% of the distributions until he reaches a 20% of all cumulative distributions, or until he reaches a 50% of all cumulative distributions, or why not an 80% of all cumulative distributions. Well, with this cash flow stream and this Pref, the maximum distribution share that the GP would be able to receive is a 73.6%, and that's because there is simply not enough cash flow to allocate a higher share to the GP. That is why at the 73.6% mark, there is simply no more profit to distribute at the last return tier. In other words, after the Pref, we spent all the time trying to catch up to an unattainable goal and are therefore never able to reach the next tier. Let's go back to our initial inputs and scroll down to the summary of partners' cash flows. Here we can see that the GP spends about a year catching up, meaning most of year 6 and a bit of year 7. Once he has fully caught up, the last performance fee mechanism, the carried interest, kicks in. During this period, the GP simply carries over with the equity distribution share that he achieved at the end of the catch-up period. So we can see how he simply carries over, getting a 20% share of distributions and ending up naturally with a 20% share of all distributions. The drivers in this waterfall are the inputs in blue font over a gray background. Those are the only inputs we are meant to be playing with, and all the other numbers we see are dynamic results and calculations. Our first set of drivers is of course the free cash flow to equity. This is the cash flow coming from and going into the investors' pockets. Free cash flow to equity is meant to be calculated independently in your own cash flow model, and is usually the last line of the cash flow statement, right before splitting it into general partners and limited partners cash flows. The GP's equity contribution share is regulated here with the GP's participation input. So with this 5%, what we're saying is that out of the $1 million deal level equity requirement, the GP is contributing $50,000 and the LP or limited partner the remaining $950,000 in this case. We can change this 5% to whatever other percentage we want, for example 0%, and the GP wouldn't be contributing any equity in dollars, only sweat equity of course, and earning a promote on that sweat equity. Or he could for example contribute a 10%, or in which case he would be contributing $100,000 of equity capital, just to mention an example. With the analysis start date, we can assign a calendar date to the time 0 in the investment timeline. According to financial theory, time 0 lasts a split second and helps us defining the beginning of the investment cycle, which in this case is important for IRR calculation purposes. So conceptually, in this case, the first column lasts a split second and the following columns last 1 year each. We can change our currency symbol from dollars to euros to pounds. This has no effect on the calculations per se, it is only for reporting purposes. We can opt to calculate the Pref on a compounded or simple basis. In the simple interest calculation method, methodology, interest is not capitalized in the calculation of the next period's interest. In other words, there is no interest on interest, whereas in the compounded interest calculation methodology there is. Usually compounded is the most typical way of calculating IRR-based preferred returns. In terms of cash flow splits and return tiers, we have the following drivers here. So in this example, we are saying that the capital will be invested at a 9:95 ratio in accordance with our capital participation input here. The return of capital will be pari passu, keeping the same 9:95 ratio. The preferred return will be set at an 8% IRR, also with pari passu distributions. During the catch-up period, as explained before, the GP will get 80% of the equity distributions until he reaches a 20% of all JV-level cumulative distributions. And finally, for the carried interest tier, the GP will simply carry over with the equity distribution share that he achieved at the end of the catch-up period. Now, the model does handle arbitrarily overriding these ratios and say, for example, that the GP wouldn't be receiving any distributions until the LP has reached his Pref, so as to make the waterfall more preferred equity-like or the preferred return more of a true Pref as opposed to a pari passu Pref. Or, for example, after having hit the catch-up hurdle, the GP could move on to a different distribution split, say 40%, and keep on increasing his cumulative equity distribution share. However, those arbitrary overrides, even though the model is built to handle them perfectly, wouldn't necessarily be the standard, particularly if the GP is co-investing. Down here we present the main return metrics any typical investor would like to look at, such as the IRR, equity multiple, contributions, distributions, distribution split, profit, payback period, and business plan duration. Now we're breaking this down by partner and we're also showing it at the JV level, meaning right before the GP-LP split takes place. But this summary is perhaps the most important piece of information of the whole model because it is answering the most fundamental questions anyone would think about when it comes to investing. How much money do I need to put in? When am I getting my money back? How much money could I make? Additionally, we show over here what the LP-GP cash flow splits are, which tells you how much each party is contributing and collecting and when, as well as this chart illustrating equity contributions, equity distributions, and outstanding equity throughout the holding period. We can see how the waterfall plays out visually. In graph number 1, we can see how profits are being split by tier among LPs and GPs. So we can see how the GP gets his 5% pari passu distribution up to and including the preferred return tier. Then he gets an 80% split during the catch-up period until he receives a 20% of all JV-level cumulative equity distributions, visible here in graph number 2. And finally, he carries over that 20% share during the carried interest tier. We see, by the way, these cash flow splits expressed in dollar amounts in this table below. Graph number 4 is the same as graph number 1 except in horizontal waterfall-like view, and graph number 5 highlights where the GP generates most of his distributions, which in this case is at the carried interest tier, mainly because that's when through the sale of the asset he crystallizes the latent capital appreciation. Finally, we've included down below a summary of the cash flows for the JV, LP, and GP. First, we present here the JV level cash flows broken down by tier. So we can see the invested capital, the return of that capital, then the preferred return, and finally the distributions during the GP's catch-up and carried interest periods. Then we see the same for the LP. Finally, we present the GP's cash flows and return summary in the same way. So let's assume we have over here the typical cash flow in which we go all the way down from revenue to unlevered cash flow to levered cash flow. And for the sake of simplicity, let's suppose that we decide that our levered cash flow corresponds to the free cash flow to equity, which would be the stream of cash flows that we would like to split into LPs and GPs. In other words, we're neglecting any taxes or working capital adjustments, which are line items we sometimes would find after the levered cash flow line. So what we do is, we copy our Promotes Waterfall Model worksheet into the workbook of our cash flow model. Next, we link the free cash flow to equity into the waterfall model, and we make the timelines match by linking the analysis start date from the cash flow model to the Promotes Waterfall model. We define the currency symbol as well as the hurdles calculation. Now we determine the GP's participation. We define the Pref and catch-up hurdles along with the corresponding GP's cash flow split during the catch-up period. And we can finally now proceed to link the LP's and GP's cash flows from the Promotes Waterfall model into the cash flow model to consolidate all flows into a single statement.